This is the Debunking Economics podcast with Steve Keen and Phil Dobbie.
The Archives.
Episode 191. We need to prepare the economy for a lockdown.
Well, central banks are cutting rates in the hope that it's going to stop panic in the money markets, and to an extent it has stopped the rapid dip in equities that we saw last week. But investors are still rushing to buy bonds and safe haven currencies. But more importantly, what's it going to do to help businesses who suffer a lack of customers as we all stay at home and self-quarantine? So if this virus gets to be a big problem, what should governments do to keep us from total economic collapse? That's this week on the Debunking Economics podcast with Professor Steve Keen. I'm Phil Dobbie. So, Steve, we have seen a massive decline in manufacturing numbers from China in data we saw at the weekend. The OECD has warned that the coronavirus could halve global growth this year. That could mean a global recession. They're not saying that's definitely what's going to happen. In fact, they've just cut their forecast for global growth from 2.9% to 2.4%. But in the same breath, they're saying if this virus is sustained, it could mean growth of just 1.5%. The response from central banks and the G7 central bankers are getting on the phone together today to discuss it. Some sort of coordinated cut in interest rates. Obviously, their concern is with the impact with the banking sector. So, I mean, we stopped buying risky equities. That's what we have been seeing. We've seen this rush into buying government bonds. That's pushed bond yields down. So then the central bank response is, well, we're going to push interest rates down as well. Can you explain how that's going to help the banking sector and, you know...
Oh, look, mate, it's going to be fabulous. It's going to do such a tremendous job. It's like giving somebody aspirin when they have pneumonia. It was totally irrelevant. And this is what amuses me about it. Initially, the initial response is, let's change interest rates, because that's the only policy lever that central banks have allowed themselves for the last 30 years in the belief they could manage the economy effectively. Well, of course, that worked brilliantly in 2008. And they threw that out for what they call unconventional monetary policies, which is what rescued the stock market dramatically. Of course, that's what turned it around. That's what's still powering it in many ways.
So why do we want to push equities up? Why do we want to see share prices, which are sort of, until this were at record levels? Why do they want to see them climbing again? I would have thought just let them rest, surely. What's the problem with doing that?
Well, that actually, even if we're getting away from the coronavirus itself directly, but that's the philosophy that Ben Bernanke put forward was we want to generate the wealth effect. So that stock prices have crashed so much, interest rates are at zero. We can't do anything to stimulate by dropping rates any further. So let's use a bastardized version of what the Japanese did, in which Richard Werner is the person who termed the phrase quantitative easing. But he had something more sophisticated in mind than simply buying bonds off the private financial sector and therefore encouraging them to buy shares to drive up the share prices. But that's all Bernanke saw going on, and his argument was if people feel wealthier, they'll spend more money, and that will stimulate the economy.
So doesn't apply now. In any case, look, the correction that we saw last week, the S&P 500 is still over 3,000. It only got into above 3,000 and stayed there and continued growing in October last year. So who's really losing, except for, short-term investors who bet on it going even further, and more fool them. And if we think that banks are going to be tied up in this loss and we'll see banks collapse, I mean, I thought we had stress tests on banks to make sure that they didn't make foolish investment decisions like that.
Yeah, but the thing is, the stress tests are nothing like the level of stress they're under with something like the coronavirus. All these stress tests are designed for episodic failures. They're looking at, it doesn't look at the contagion effect, which is hilarious now because we are talking about one serious case of contagion, and yet they're still thinking in very linear ways. So the idea that you can save everything by dropping interest rates, or even that doing standard old QE will somehow get the economy through this, it just doesn't work because even on the QE front, the idea that it causes the wealth effect. A little research body with the obscure name of the Federal Reserve published a paper about 15 years ago saying when they went looking for the wealth effect with shares, there was none. The only wealth effect they could find was a minor one with house prices.
Yeah.
So it hasn't done what they wanted it to do in terms of directly stimulating the economy via private sector consumption. It's been the indirect flow over that's had any real impact on the real economy.
Well, who's going to be buying shares in a company that is suffering because people aren't buying its products because they're stuck at home and they can't produce those products anyway because their workers are stuck at home as well? I mean, it's foolish. It's foolish to expect that we're going to see massive growth in share prices. Surely.
Yeah, that's why I think the old-fashioned QE won't work to continue supporting share prices once the scale of the coronavirus impact on commerce becomes blatant. Because if you give, the whole idea is an indirect thing. You being the Federal Reserve, pump $80 billion a month, and that's what they were doing during full QE, $80 billion a month into the financial sector. They get the cash, they hand over the bonds to you. Now, they've got the cash, which doesn't return a yield, so therefore, if they're looking for yield, what they'll do is they'll go and buy shares. And that's what happened when S&P bottomed at 666 points back in, I think, about sometime in 2010. And since then, it's rocketed up to heading towards the 3,000 levels that it is these days. But if you try to do it again now and say, please buy risky assets when those risky assets are going bankrupt because the companies aren't selling anything, the workers can't produce anything, I think that it's going to sit on the money. It won't have the same effect anymore.
I mean, even what they're trying in China, where the central bank is freeing up the reserves for the commercial banks, supposedly so they can unleash more lending again. They're not going to do that, are they? If lending to
they can't. There's the other myth. We've got a bunch of myth believers running global economies, and one of those myths is that the banks actually lend reserves out. Now, thank God the Bank of England in 2014 pointed out that was a myth, but it's still the way politicians, a lot of the public, and bureaucrats running central banks still think. They've got two ineffective tools.
Well, I think they're saying, no, we'll reduce the amount of reserves you need so that you can lend more out. But I mean, you're not going to lend more out, are you? Because you're not going to lend to a company that you think is going to go bankrupt because no one's buying from it.
Yeah. We're just looking at a complete failure of conventional tools. So we've got to start thinking of unconventional ones because this is going to cause a large number of bankruptcies, both on the corporate, the non-financial corporate side, and on the side of workers, and that has to feed through to banks, which are one of the institutions that central banks see themselves as protecting.
So it sounds like what you're saying is then, however we solve it, however we get money to where it's needed, it shouldn't go through the finance sector. This is a problem for governments to solve, not for banks to solve.
Yeah, well, this is one time we cannot imagine a private sector solution to a systemic crisis like the coronavirus. This is something where, in fact, everything the private sector normally does will make this sort of crisis worse. So if you insist that companies have to be able to pay their debts as and when they fall due, which is standard bankruptcy rules. Given the fact that corporations are now carrying the highest level of corporate debt to GDP in history, and this is quite different to household debt. The household sector in America deleveraged after the financial crisis. So did the corporate sector until QE began, and then since QE's happened, they've gone from a level of private debt to GDP at the bottom of the downturn in mid-2012 of 66% of GDP. It is now 75%, and that exceeds the previous peak, which was reached during the Great Recession of 72%. So we've got the corporate sector being the most indebted it's ever been, and the workforce that works for them is the most fragile it's ever been because of the gig economy, all the insecurity, the lack of full-time jobs, and so on. So the real economy, which is what we actually are trying to save with all this stuff, will be on its knees with coronavirus, and we have to get the Federal Reserve's powers redirected towards the real economy this time rather than just towards the banks.
So is it the Federal Reserve or is it central governments to do this? Because the company, I mean, it is vast, isn't it? Travel companies, international education, entertainment, restaurants. I mean, they're the obvious ones that are going to be hit hard by this because they will just have no business whatsoever. But then, as you say, there's all those, the gig economy, the freelance workers, and generally every company is going to take a hit because, whatever you're selling, you're going to be selling less of it.
the only people who are going to make a fortune actually are toilet roll manufacturers. Every supermarket I've been into in the last couple of days is empty of toilet rolls. Everybody is backing up on toilet rolls. So you want to go to the toilet, we're going to be fully prepared. You want to feed yourself, it could be a problem. So it's ironic how we react to all these things. But yeah, it's the scale of the shock is so great that we have to say, let's use those tools differently. And I don't think that fiscal stimulus will be enough or fast enough. We have to get money directly into people's bank accounts, and we have to avoid let companies that are forced to be unable to pay their debts during the coronavirus crisis, which might could last 1 year, 2 years. As long as it lasts, we've got to stop them going bankrupt because of it, and stop individuals going bankrupt, being unable to pay their rents, unable to pay their mortgages, and frankly, for some, unable to pay for food.
Which is exactly what Scott Morrison in Australia has said he won't do. So Kevin Rudd, of course, I think it's just about the only place in modern times where this has been tried, where he, during the 2008 crisis, actually put money directly into our bank accounts to try and boost spending. Scott Morrison said we won't be doing that. But would it do much anyway?
Oh, good. Another thing he said he won't be doing that he's going to be doing. That's going to be fun.
Join the list. But, I mean, if it's there to pay off debt, I mean, if you give it to everybody willy-nilly, is it actually going to be that effective? Because we're not going to go out to shop. So for a lot of people who aren't on the borderline, all they're going to do is pay off their mortgage that little bit more. How do you... if we're self-quarantined, we're not going to spend our way out of this problem, are we? It's not going to help companies sell more stuff. All it will do, if you're putting money into people's bank accounts, is it's going to stop them going bankrupt. If it's going to pay for their mortgage, it's going to pay for their rent.
Yeah, and that's the thing we have to avoid, because what we face right now is it's a pandemic. There's no doubt of that. The fact that WHO refused to declare it one because they were worried about global trade is a sign of how perverted our public institutions have become by focusing upon commerce rather than what they're actually supposed to do. But with this virus, we have twice the level of corporate debt that applied during the last pandemic, which was the Spanish flu, and 3 times the level of private debt compared to GDP that we had back then. So, financially, we're in a very fragile situation. And at the same time, when the Spanish flu began, it was actually began in January of 1918. We're still embroiled in the First World War. You had a large part of the population either in the army or working directly for the army. So there was an income distribution which was independent of the private sector, and debts were 1/3 the level that they are now. So there was no, knockdown financial fragility back then. There is potentially knockdown financial fragility now, and we have to do something about it.
So do we, for example, give companies... If we look at it from a company point of view rather than individuals, we can work our way through this. But if we started with companies and said, well, if you are close to bankruptcy, we will give you some sort of, I mean, it exists now where you have some sort of safe haven, some sort of a safe harbor, if you're getting financial help if you're getting a turnaround consultant to try and help your business. So you're saved from running a company that's on the verge of bankruptcy or is insolvent. You're solved from it. You don't face the legal repercussions of that. So do we sort of extend that sort of legislation and say, plus you can have an interest-free loan for whatever period, for a year or 2 years to get you over this hurdle?
Something, I think, even more extreme than that, because we are going to see corporations going bankrupt because they're no longer able to produce output because the supply chain is disrupted from China. So the production will be impossible. They're going to lose demand as well. They're only going to be people who are selling directly into what people regard as emergency purchases. I mean, I made the slightly facetious remark about toilet roll manufacturers, but, them hand sanitizers, masks, et cetera, they're going to boom through the roof. But the vast majority of normal industries, from transportation, education, food, restaurant food, obviously, more so than purchased food, they're going to suffer dramatically. And in that situation, unless we do something, they're going to go bankrupt, which means they'll put their workers out of work, which means the workers won't be able to pay their own bills, which means the workers will be unable to pay their mortgages, and it feeds through the whole financial sector. So we have to do something, both letting companies operate when they'd normally be made insolvent, potentially actually classifying companies and saying, we are going to give you a cash flow from the government in the meantime to make up for the damage to your cash flow from the coronavirus. And I think we've got to do what I've been arguing for ages about solving the cause of the last financial crisis. We need not a modern debt jubilee, but a modern virus jubilee.
But it amounts to
we've got to get money directly into the bank accounts of individuals and households.
Right. But I mean that could be huge. You could be talking about a massive amount of money, some of which you could argue is going to be misdirected, because there's going to be people who are doing fine, sort of retirees who have got their money sitting in safe bonds, who are not going to struggle through this crisis at all. Apart from the fact they're elderly, they might die.
That's what the argument I made for a modern debt jubilee about a decade ago was to say we should give government created money on a per capita basis, so everybody gets the same amount of money. That's going to benefit the poor far more than it does the rich. And that's the ones we're worried about, are people who are on insecure jobs, the gig economy part of the world. And we want to find a way to get money into their hands. In the original case was so that we could reduce debt and not have the moral hazard issue that those who didn't get into debt got nothing, which is what happens with the standard jubilee. But this time around we want to get cash in.
Yeah, but and that's the repercussion of businesses closing down and people finding themselves unemployed and they can't afford to pay their bills. But I mean, the ideal obviously is that we don't get to that stage and we want to keep companies going. How do we do? Because that doesn't solve that problem, does it? And there's going to be some companies that are close to failure and other companies that are going to manage to somehow scrape through this crisis. How do you deal with that? Because I mean, there has been talk about, for example, in some places, well, if you're running losses at a certain level, then we'll give you some support. But of course, we all know it's fairly easy to make a company make a loss. On paper, you just buy a few things that you didn't intend to buy. I'll build another studio, for example, and I can make a loss very easily.
But I think this is when we can identify the industries that are going to suffer.
Yeah.
In terms of consumer demand, we can identify that straight away.
Yeah. But do we say then that at the end of this, we think companies should come out of this crisis exactly the same as it went in, which could cost a lot of money? Well,
I don't think we should. This is a genuine systemic crisis. Okay, it is something which you can't blame on any individual. The question is, what do you want to have happen? Do you want to have the system collapse more because we leave resilience as an individual level action, or do we take then collective action, which we can do? And if the collective action has some unfortunate consequences, they're not quite as unfortunate as letting the system run on its own. This is a classic reason why you can't say you can have an individual remedy to a systemic crisis. It's like saying, you should have brought your own paddle on the Titanic. Why haven't you got your own? Why didn't you bring your own canoe with you? I'm sorry. If you got to provide enough boats on the Titanic in the first place. Now we're in a Titanic situation here in the sense that if the coronavirus can only be stopped by shutting down commerce for effectively some of the order of 1 or 2 months, and that's quite feasible, then you've got to provide some way that people can survive that period. Which you can't be reliant upon their own cash flows because they won't have one. So
I run an Indian restaurant, and gee, that would be a good life. But I'm going through a difficult time. I closed down the doors, and the government gives me enough money for me to be able to pay my workers and myself so that when the crisis is over in a few months' time, I can open the doors and resume business as normal. Is that what you're suggesting?
Yeah, pretty much. I don't want this to have financial consequences. If it does, it'll make the situation far worse.
Right, but the money paid for that would come from the government, from central banks. Who is going to be paying for me? Central
banks. I mean, this is what QE has been. QE, one advantage of QE, it's been a very ineffective policy compared to what could have been done, but it did work. And there was obviously no limit to the capacity of the government to do it. They simply bought bonds for $80 billion a month. The US government was on the buy side of its open market operations with financial institutions, and it put $80 billion worth of cash net in the financial sector's bank accounts every month. It recorded $80 billion worth of bonds on its asset side, and it can do that indefinitely. So what it could do instead, is potentially it could in listed companies it could buy shares instead at the same level, which would support share prices and also give those firms a cash flow if they're issuing new shares.
But how does that help the small business? How does that help my Indian restaurant?
Small business, you've got to have a provision say, okay, which small business is going to get hit by this? And clearly, anything in education, transportation, direct personal services, all this sort of stuff is going to be hit. Their cash flows are going to plunge. And it's obvious they're going to plunge because once it gets severe, you'd be actually risking not just your own health, but public health to go and use any of these facilities.
So talk me through how that gets through a decision from the central bank to me at my Indian restaurant. How does that work in practice?
Well, that would not be the central bank. That would have to be the government having a set of rules saying which businesses are we going to regard as being hit by this. Obviously, if you're making toilet rolls, don't come begging, okay? Unless you run out of paper because you're no longer getting supplies from China. So there's a supply chain issue and there's a demand issue. We know there's not going to be a negative demand issue on people hoarding and buying food. That's going to be a huge boost initially. Anybody producing dried foods, anything which can last for a substantial period of time, they're going to be winning on demand. Everybody else is going to be losing.
So we have central banks basically extending the money supply through QE, which they're using to invest in equities in the share market. We have central governments basically running debt, which again is extending the money supply so that they can support these businesses that would otherwise go against the wall. So we are talking about a big increase in the money supply through all of this, aren't we? Like a massive increase, which normally we'd say would be inflationary.
Yeah, but the thing is, what you've got is a plunge in the turnover of money, and this is I often come back to people obsessing about the money supply and forgetting about its turnover. And this is one classic case. People are not going to be spending.
Yeah.
And so if you have a plunge in the velocity of money, one way to counter that is to have an increase in the supply of it.
How do you pull back in a few months' time when my restaurant opens again and everything's all fine? This virus has strangely been eradicated. How do we pull back that supply and money?
Well, I mean, what it might also do is end up reducing the level of private debt compared to GDP, and I would not be crying any tears over that. Now, I proposed a modern debt jubilee, and people ask me, what are the odds of this happening? I would say negative, okay? It's just simply not going to happen. Now, a modern debt jubilee directed at the virus rather than directly at private debt may be the only way to stop this turning from a viral contagion into a financial contagion that could break the financial system.
So we need to also change laws around bankruptcy, obviously, wouldn't we, in the short term? No, I haven't heard that being discussed, and yet it seems like the most obvious thing to talk about first. How do we stop businesses go to the wall? Well, let's change the laws around it.
Yeah, you've got to change the laws around banks as well because even though, of course, if banks have got shareholdings and the shareholders have been pumped up by QE, then, of course, they've got massive positive equity buffer right now. But when they start finding their customers can't pay their debt, if there is a huge sell-off in shares, and that's quite feasible even with QE, then when this really hits, then lots of banks could find themselves with negative equity, and therefore they would normally be forced to declare bankruptcy. And we have to say, no, in the particular circumstances here, we'll let you continue operating. Okay? And you've got to let them continue operating. You don't want the monetary system to break down because of the virus, because that will then mean that people simply can't shop, and then we're going to have starvation effects as well as the virus, and that will make the virus grow more rapidly.
I mean, it is the problem, though, isn't it, that we had in 2008, where we don't want the banks to fall down over this, although if we don't let the banks collapse, then all we're doing is supporting their behaviour, which obviously has been not to countenance risk in the way they operate. So, for example, I wonder whether...
another thing we could...
I wonder whether...
Another thing we could do...
Yeah, you go. Go on.
Sorry. Another thing we could do is bring in central bank digital currencies.
Yeah.
I know the bigger bank, I think, was looking at this, the Bank of Sweden, China's central bank. A few central banks are looking at bringing in central bank digital currencies. So if that existed, if the framework existed now, then we could give people money through their central bank accounts. And that would mean you wouldn't necessarily have to support the banks because you could still have transactions using money created by the central banks. But nobody's got there yet. The disease got here before the idea did. But that's another way that this could be done.
I wonder how much of the massive volatility that we've seen over the last week is because of the liquidity issues, because dealers have not held inventories. They basically buy and sell quickly. So when there's a panic on, they have to rush to find a buyer, so prices dip because they have to sell. If they held bigger inventories, which they did, they used to warehouse bonds quite a bit more, right up until 2008, basically. If there was more of that warehousing of bonds, there'd be less panic. Maybe this is the sort of regulation that needs to be re-examined. Maybe we need to get tighter, not just on banks, but the broader financial institutions as a result of all of this.
Yeah, potentially, but this is otherwise it's an aberration. I mean, it's an aberration we're going to have to live with because this is one of the points of climate change. I'm not saying coronavirus is caused by climate change, but coronavirus is caused by the same thing which causes climate change, which is excessive human pressure on the biosphere. And therefore, if we're given what climate change is going to bring forward, shocks like this are going to happen all the time. They're not exogenous. We've caused them by overstressing the biosphere.
What do you think is going to be the long-term consequence of all of this then? Are we, for example, is internationalization more into question? I mean, it was starting to be anyway, wasn't it, through Donald Trump's actions? We've seen how precarious international supply lines are. Maybe we'll be rethinking all of that.
Yeah, I mean, globalization has to pretty much die if we're going to get over climate change in the long term anyway. This is just a bit of a foretaste of it because I haven't looked to find how long it takes for a container vessel to go from Shanghai to Los Angeles, let's say. But I've seen people saying it's something like 2 or 3 weeks. Now, you imagine being a seaman hopping onto a boat where you're going to be in a confined space for 2 to 4 weeks with people who may have the virus. You're going to voluntarily say, no way, I'm getting on there. And the only way to make it feasible to continue the shipping is to quarantine the crew before departure for at least 2 weeks, maybe 4, before they hop on board. Then, once they're quarantining, nobody's got it, then they can take the boat across the ocean. That is a sign of how fragile our production system has become. And this is where Nassim Taleb's famous phrase of anti-fragility, I think, is really sensible and important. We've designed an incredibly fragile system. Just-in-time manufacturing, which has reduced production costs, relies upon almost instantaneous delivery just in time for the production process. That works when you have a smoothly functioning global system. When you got a curly like this thrown in, and we've been pushing ourselves further and further this way by overburdening the planet as we have, then that's not the system you want. You want to have massive stocks. So we are really very, very fragile to a shock from something like the coronavirus.
So you've described what should happen. There will be people, of course, who are saying this all seems a bit extreme. It seems like an overreaction. What do you actually think will happen? How is the next month or two going to play out in terms of how the virus is going to spread and how the governments are going to react?
Yeah, I think they're going to, as usual, they're going to underestimate the dangers and then overreact when they realise just how bad it is. So I've been looking at the level of growth of the virus infections in different countries, and I'm just going to read out a set of numbers to people. So this is going to be really fascinating radio. But the numbers are 43, 12. 0, 0, 0, 0, 0, 0, 0, 0, 0, 2, 2, 2, 2, 2, 2, 3, 3, 3, 3, 3, 3, 3, 3, 20, 62, 155, 229, 332, 453, 665, 80, 88, 1128, 1694, 2036. Okay, the $90 question, what am I reading out?
is
the number of cases in Italy.
Italy, I was going to say, yeah, lots of zeros there, but the numbers definitely got bigger towards the end. Even I noticed that.
All of a sudden, okay, you had this period where it's minor, it's actually seemed to be going away. Then you get this what really is a hyper exponential growth rate. So when you look at the numbers and say, what's the doubling period? It's 2 days.
Yeah.
So the numbers there.
But is it sustained? That's the question, isn't it? I mean, if it was to double,
it'll fall. It'll fall from that initial level. But that's that when it starts taking off, that's how fast it grows.
Yeah.
And the doubling period, in terms of revealed cases in Italy, is running at doubling every 2 days. Now, we're not going to see that rate sustained. It's not that infectious. This is really discovery rather than infection. But it appears to, once it settles down, unless you take major efforts to isolate people, which is what China's been doing, its doubling period is about 6 days. Now, doubling every 6 days means that by the end of the year, you've got something like 60 times to the 2 to the 60 times as many cases. Now, if you remember the old story about the philosopher who helps a king win a battle, and the king says, "Well, you can have anything you like," and he says, "All I ask is 1 grain of rice on the first square of a chessboard, 2 on the second, 4 on the third, etc., etc." And the king thinks he's got a bargain until he finds his entire kingdom and half the planet's been signed away, so he executes the philosopher. Exponential growth catches people by surprise, and our politicians are going to come into this too late. They're going to think it's containable, think they can handle, get away with it, and then the virus doesn't listen to politicians. It'll start putting exponential strain, and then we'll finally decide that we've got to do what the Chinese did, which is massive isolation. And massive isolation doesn't work in a capitalist system. We have to find some way over it. We can't do what China has done as drastically, but we've got to find some way to let people isolate themselves and not go bankrupt and not starve.
Okay, and we're going to do that by... we come out of this with businesses saved, but we come out with central banks having issued a huge number of extra bonds, and companies that...
Not bonds, buying shares.
Buying shares, sorry. Yes,
as well as like they can create the money. They don't have to buy bonds to create the money. They could do what the Bank of England does with the Titans, where to back the Scottish currency, they issue the currency. The Clydesdale Bank and all that mob can produce their own Scottish notes, which circulate in Scotland to some extent in Britain, in England, and they're backed by £100 million notes and called Titans in the Bank of England.
So basically, like writing their own check.
They could do the same thing.
Right. Okay. Yeah. So they're buying equities, and they're making a call on which ones they're buying. Similarly, the governments are there saying, well, okay, we're going to rack up some debt, but that's fine because we can create money to cover that debt, but we're going to pick our winners in terms of the businesses that need supporting. We're going to have a lot of very disillusioned people who are saying, well, okay, you didn't pick my business. I've been struggling financially as well, and this finished me off, even though I wasn't one of the target industries. I mean, I don't know how you administer it.
Yeah. I think you do it on a blanket basis. You don't try to target individuals. This is one reason why Obama's so-called rescue of people with mortgage distress never worked in America. They're supposed to be something like 1 million people were supposed to get their mortgages fixed up. There's order of 1,000 people that actually got any benefit out of it because the bureaucratic way of handing out the help meant it never got there. You have to say this sector is going to be affected. We're giving every firm in this sector amount of money proportional to their share of the sector.
Do you think we will get there? Because this could go one of two ways.
I think we'll be forced into it.
Right.
I think we'll be forced into it.
In the next few months?
In the next few months, because with a doubling rate of every 6 days, I mean, I used to be able to do this stuff in my head.
Are you ready to climb Mount Kosciuszko if this doesn't happen, by the way? I mean, you're in Australia now. You're quite handy for it. If we don't see, it's almost your People's Jubilee. If we don't see that happening, this debt jubilee, People's Debt Jubilee happening in the next few months, you've got to go back up that mountain, Steve Keen.
Yeah, then we're in serious trouble, and I'm willing to take a bet on it. I mean, because if you look at...
might be a good place to be. It might be the safest place to be, mind you, the top of Mount Kosciuszko.
It would be. There's 365 days in a year, and the doubling rate is 6. 6 days at the moment, unless we manage to reach a level of quarantine like the Chinese have done. Now, this is not going to happen. I'm not saying that this is not a prediction by any means. It's simply showing what happens if this rate of growth continues. Then that means that within 1 year, the number of people who will have the coronavirus will be 2,000 billion people. Of course, there aren't that many people. Okay, that's what happens when you have a doubling out every 6 days.
So, I mean, then it all gets down to connectivity, doesn't it? Because the Spanish flu did reach a third of the population, and we obviously are much more connected than we were then.
Yeah. If you reduce the doubling rate to every 31 days, which every month rather than every week, effectively, then your number of infected cases is down in the thousands. So that's the impact of being able to quarantine. So if you can reduce the doubling rate from every 6 days, or every week, say every month, then you reduce the number of infections from ridiculous, everybody's on the planet's got to have it, to 3,500 cases. So isolation works. Okay, so we have to find a way of isolating people and slowing down the transmission rate, and it does have an impact. We're talking exponential factors here, and people aren't used to thinking that way, and that's the trouble.
And the argument
we are now having an exponential crisis.
Right. So the argument there is very simple, isn't it? Contagion costs money. People need to be paid because they've still got their outstanding debt. So either we give them the money, or somehow we stop money systems operating for a couple of months. We say, well, okay, banks are not going. I mean, there's another way. Why don't we say to banks, don't ask for mortgage repayments for the next few months. Just push it back on the end of everyone's mortgage. That would help. Yeah,
that sort of thing. I mean, but the thing you've got to say, landlords don't ask for rent.
Yeah.
I mean, the other thing is we've pushed out the whole idea of the rentier. Well, we've created so many people who think they're top landlords these days. They are not going to want to have their tenants being able to pay the rent.
Right, but if they're not,
got to get cash to people.
Right, absolutely. But if those, if those, and we're out of time now, we've been talking for too long. But if those landlords are paying mortgages because they've leveraged the point.
Yeah, it cascades through.
Then you could say, you're not having to pay your mortgages, therefore you're not able to charge rent either. We're going to make it a law for the next few months. You can't charge rent. Banks can't ask for mortgage repayments. That would be a big step forward, wouldn't it?
That's one way to go. We've got to find some way because we have to reduce this contagion rate. And just to give you a few ideas of scale, if we reduce, we're living at the current doubling rate, it's literally millions of people, which of course means the entire population gets it. If we reduce it to every 2 weeks, then there'll be 70 million people who get infected. If you reduce it to every month, there'll be 3,500 people who get it. So the impact of slowing down the contagion is huge.
Right.
So we have to say we have to do that.
I'm not going to. I'm going to get a little food hatch fitted at the door of the studio. I'm not leaving. Good to
there you go.
Good to talk, Steve. Well, I hope you're okay in Australia. You've got to fly back. Wear a bag over your head.
Yeah, I've got my masks with me.
All right.
Yeah.
It wouldn't surprise me in the slightest. See you soon. See you when you're back here. Thanks. Cheers.
Okay, mate. Bye.
And if you've not heard it before, that is an example of the Debunking Economics podcast. Steve Keen and I do this every week. This is just an extra one this week because of the coronavirus. But if you want to listen to the full version of each week's podcast, you need to become a subscriber at debunkingeconomics.com, or you can become a supporter of Steve Keen on Patreon. Go to patreon.com/Prof Steve Keen. And we'll hopefully see you next week for another one. Thanks for listening. If you've enjoyed this podcast, then please share it with your friends, like it on YouTube, and subscribe to this channel.